So 5 steps to find good trades. First step, set the scene. What do you mean by set the scene? Okay, set the scene for your trade to happen. For that, you need to understand what the markets have done in the past. Try to understand what the smart money is trying to do now. What the hell is a smart money? Smart money are those traders who have the experience, who have the capital, who have the know-how much better than all us retail traders. Need to understand what they are doing. How can we do that? Is there a way where a technical method that will mark, okay, this order was placed by smart money? Absolutely not. But there are ways where you can understand how they behave in different situations and then monitor if that behavior is being repeated in the markets. So you need to do that. When you start applying these framework and using these methods and tools, your level will start going up. Obviously, you are not going to become the smart money, because there is one very critical aspect, that is the capital that these big institutional traders trade with. Retail traders, it's difficult for us to match that level. So if you are still a retail trader, you will be much better than the beginners, but obviously not to the level of the smart money. So you need to keep an eye on what they are doing, at the same time what the amateurs and beginners are doing, what mistakes they are repeating, because exploiting those mistakes is the only way you are going to make money consistently. And then you have to mark some important zones where the buyers and sellers were dominating each other. Mark your trade locations. What do I mean by? I'll show you an example, so don't worry. Trade location is something which tells you where you are going to buy or sell, not when. Where? When comes in the purview of timing. When I said finding trades, you are finding good trade location. First step involves all this. Let's look at a simple example. This is that example. Same thing we saw. Now, first and foremost, you need to understand that we were trading in a sideways zone. Then there was an attempt to break out, which did not succeed. We came back down. So this breakout level is an important reference. Then there was another important reference, and that was this gap down. So that was again an important reference. So you monitor all these trade locations. Why? Because when prices come back to those trade locations, you get sharp reactions. When prices went into this gap zone, see how it reacted over the next 4 days. Forget about 4 days. First, when we come to this level, that's the top of this range, see how it reacts sharp. You could have taken a short-term trade here. Absolutely. That is what is more important. You need to understand where the trade locations are. Now, on this particular day, big down day, you can see where it stopped, right at the bottom of this sideways zone. So again, a trade location. Bottom of the zone, obviously, all the short-term traders will try to protect this range. They will not let the prices go beyond this range. They are expected to come and buy here. So you need to mark this trade location and see when prices come here, and if you get some indications that tell you that, okay, traders are buying, you could have taken a short-term long trade. Find out the players. Now, I am asked this question like at least once or twice a day. Which time frame is suitable for intraday trading, for swing trading, for long-term trading? Alright. Time frame, like objectives of traders will change, intraday, swing, all those things. But they will ask me, shall I trade on a 5-minute time frame, 15-minute time frame, 1 hour time frame? And I keep telling same answer to everyone, is that 5 minute, 15 minutes, 60, 240, whatever is not a time frame. It is a chart periodicity. Chart periodicity is the setting that you make in your technical analysis software as to how many minutes of price data you want to plot. That is not a time frame. All trades will show up on all charts, right? 5 minutes is the chart periodicity. That word is used interchangeably. Sometimes I refer to a 5-minute time frame, does not mean it is a chart periodicity. So what is a time frame? There is a big difference. A time frame refers to how long you want to hold on to a trade. I want to hold on to a trade for 1 week. I'm trading the weekly expiry. That is my time frame. I don't want to carry positions overnight. I am an intraday trader. That is my time frame. I just buy and forget. I am an investor. A very, very longer time frame trader. Now, why time frames are important? You need to understand what time frames are responsible for what kinds of moves in the market. Higher time frames, investors, institutional traders will be responsible for bigger moves in the market. Intraday traders will be responsible for smaller moves, and you always side with the higher time frame. I want you to understand that this confusion has destroyed many trading careers. If you confuse chart periodicity with time frames, you're losing out on very crucial part of market generated information. Third step, develop scenarios. Like if longer term traders are buying, obvious scenario is markets will go up. If a resistance come across, we will break through it. We will not fall from there. Or even if we fall, that will be a temporary fall. You can use that pullback as a good place to buy. That is what I mean by developing scenarios. Why are we in a range? Because shorter term traders are controlling the market right now. Higher term traders are not committing. Maybe they are slowly accumulating their positions. Once their accumulation is done, they will push the markets and then we will get a breakout or a breakdown. Markets don't know what you think and they don't care what you think. What you think matters to you and your trading capital and trading account. Make an assessment, develop a scenario, but also develop an opposite scenario. We'll look into it in greater detail as we move on. Alright, so develop different kinds of scenarios. All these kinds of scenarios will help you remain flexible in the market. Let us move on. Example of making scenario. A lot of you have heard about this popular terminology which I use in my trading, and I call it potential auction paths. What I essentially do is I mark important trade locations, like this rejection or gap, like this bottom of the trading range, and then I develop a few scenarios. What if market goes there and gets rejected quickly? What it means? What if market goes there and spends time instead of getting rejected and then probably break out later? What that means? What time frames are responsible for that? Just look at this. We come back down and then we, instead of going lower, we get rejected. Now we are again back in the middle of the range. So that tells me something, that some demand has come in from this lower side. Probably we will go and tag the opposite end. That's the destination. If you find demand at the bottom of the range, you go to the top of the range. If we do not go to the top of the range, it tells us that the buying that came in here was not so strong, and then there is a possibility of a breakdown. So next time prices come there, you be very careful that there is a possibility of a breakdown. Isolate reference zones. Again, I will tell you that once you have developed multiple scenarios, you move on to this step. Carefully select references based on your time frame. Let's say there is a multi-year high and you are an intraday trader. Now, it does not make any difference to you if prices go to a multi-year high, because it is a big time frame and your objectives are small. You want to be an intraday trader, so you look at references that refer to your time frame. For an intraday trader, yesterday's high is more important than a multi-year high, because yesterday's high will help that trader make an important trading decision. Multi-year high won't. Where you would like to take a trade is more important, and it is completely controlled by your time frame. As in, are you an intraday trader? Are you a swing trader? Are you a positional investor or positional trader, whatever that is? And based on that, you'll have to isolate the references. If there is a 1 month, 2 month range, short swing traders are active at the top and bottom of the range. So if you get resisted, short swing traders are selling. If you break out, an even higher time frame is now active. You see, this is a potential supply zone. This prominent point of control is an important resistance. This would be a good place to short. This is the bottom of the range. This will be a good place to buy. But if the markets come here, do I sell blindly? Or if the markets come here, do I buy blindly? No, I monitor the price action. So when markets went here and they did this kind of price action, I said that SM may be selling. Then there are obviously some rules that we use to filter out trades. Like in this case, if the value is forming higher, we won't short. But on this day when the value formed low, there was an opportunity. So you just don't go blindly buying or selling at your choice references. You monitor what the markets are doing there and then only you take a trade. And lastly, you identify both expected and unexpected behavior. Now what does that mean? Traders usually follow the first 4 steps very well. And then they come to a market view and then they decide that maybe I will short or maybe I will long. But when it comes to taking an actual trade, like I said, you get married to your trade idea. If you feel the markets are weak, you only think about shorts. And what happens is, if that bias gets created in your mind, you won't be able to monitor the changes that are happening in the markets. So if there are changes happening in the markets, what will happen is the scenario will change, time frames have changed, different time frame is in control, different from one you thought was in control, and now markets are going to react differently. opposite to what you had thought. But if you have a bias, you won't be able to focus on these changes and be flexible. And if you cannot be flexible, God help you in trading. Traders accuse me, they say that okay, Dean shares both long and short possibilities. Anyone can do that. I understand. But if you come to me, if you have discussions with me, if you listen to me talk, then you will understand why I do that. Because you have to be flexible. And then I have a strong logical reason behind that. So we are in a tight range. Obviously, at the bottom of the range, expected behavior is that we will find buying. At the top of the range, expected behavior is that we will find selling. But I will have to be prepared for unexpected behavior. Like if we come to this resistance, instead of getting rejected, we spend time here. It tells me something that the sellers may not be strong now. And then there is a possibility of a breakout. Same happens to the downside. So I need to be prepared with all these scenarios. Because if the market changes, I need to adjust my positions. Otherwise, I will lose out. And since I don't take all trades with entry, exit and stop loss, I might be in a big trouble. That does not mean that I don't advise putting in a stop loss. That depends on the way you trade. Like if you are buying a futures contract, obviously you need a stop loss. But if you are using options trades, you don't need to put in a stop loss. You can adjust those trades, right? So let us move on. So this is how expected and unexpected behavior will look on the charts. That was a 5-step process. Maybe you go ahead and you start using that process in your trading with whatever method you like. The important point is to monitor your results. Now, when I say results, traders immediately start thinking about the P&L statement. Profit and loss will improve over a period of time, not immediately. If you are expecting that, be prepared for a rude shock. It's not going to happen. Only after a prolonged period of sticking to a process, you will see improvements in the results. But are there other things that you can track? Absolutely. See how you deal with profits and losses. If you make a big trade, are you happy with the profits or are you looking for the reasons why that trade succeeded? If you make a loss, are you depressed, losing confidence, or you are trying to learn from that experience? Try to make those slight changes to your process so that you can use your methods in a better way. If you can follow these things, follow the process consistently, and then get the results as well as stay calm and collected, you are onto something. You want to see this process in action? Well, I have taken an options trade strictly based on this process. Watch this next video to know all about that options trade. If you like this video, give it a thumbs up, and if you don't like it, leave your suggestions in the comments below. Want to learn more? Consider subscribing to my membership. Links in the description below, and I'll see you in the next one.